personal risk, you have property risk, you have public risk. So personal risk is something which is related or connected to an individual directly, like the death or disability, health, insufficient income during retirement, unemployment. So all these are different types of pure risk, something which can lead to losses because of a person directly, because of the individual directly. So that is called personal risk. Property risk is if you have certain asset and that asset gets affected because of that asset catches fire or theft, burglary, and there is a loss. That is called a property risk. Okay, so any risk or damage to the property, like your house or office, car, or any vehicle, plant and machinery, building, all these things, if there is any loss due to fire, theft, natural calamities, and all, then it is called property risk. Public risk, as I gave an example, that if somebody is driving a car and there is a third party risk where you can go and hit somebody's property, somebody in person. So these are actually considered to be public risk. Because of you, outside public, somebody else is getting, or it is somebody else is suffering or getting the loss, is called public risk. Now, in these types of risk, there is no maximum upper limit. For instance, we saw this example where the third party in car insurance or car insurance, the property risk, there is an upper limit given. Upper limit of some 7.5 lakh rupees limit is given for the property because it is quantifiable. But when it goes to the personal risk, then the risk is unlimited because whatever the court decides, that has to be paid. So there is no maximum upper limit for property risk, for public risk. The lien can be placed on the income and financial assets. Now, over here, assuming you do not have an insurance and uh, there is an accident and the court says that you have to pay 1 crore rupees to the person to whom you have hit. You says, I don't have 1 crore rupees with me. So what court may say, you tell me what is your income. So you will say that you are earning 10 lakh rupees per annum. Court will say that every year 5 lakh rupees you give to this family. Okay. You pay 5 lakh rupees every year for the next 20 years, 25 years, something like that. Or they may say that, okay, TK, you don't have money, you show what are the assets you have. You say, you will show that, okay, I have a house, I have this land, I have mutual fund, there's that. So they will take the list of all the property and they will say that, okay, out of your property, these are the properties, you transfer it to them. So now let us look at risk management. As we discussed in the beginning, that we act like a risk manager in the life of our clients. How do you do risk management, or how does a risk manager work? So if you look at a corporate risk manager, what will be his objective? The corporate risk manager objective is to identify the risk, like wherever the risk is there. He will first try to identify what are the different risks. Then he will try to evaluate that, okay, then these are the risks, then how severe it is, how big it is, how uh, consequentially big it is. And after evaluating, then he will start exploring the options, that what are the best ways of covering it. And then he will implement that particular, he will make a plan how to cover that, how to do that risk management. And then ultimately he will implement it. And after implementing, he will review it. That, okay, fine, okay, last time I did this risk management, these were the plan of actions. And he will continuously monitor it, that whether just to make sure that everything is going fine or not. If there is any additional risk which got added, do I have to do something else? So that is basically the role of a risk manager. What is risk management? Risk management is a process that identifies the loss exposure faced by an individual or an organization and selects the most appropriate technique for treating such exposure. Okay. So it is basically it's a process where you are identifying the risk and selecting the most economical, most simple, most suitable method of protecting and covering that risk, and then implementing and reviewing it.